Hello guys, welcome back to my channel Accountancy. Here I am with another question on the provision for depreciation basis. But here the new point is that the machinery balances are given on 1st of April 2024 and provision for depreciation balance is also of same date. But the machinery sold date was different from the date of the purchase, date of the given balances. So first of all, I am given that machinery balance. As machinery is asset, it would carry a debit balance. It was to balance brought down. Point to be noted here: the asset was not purchased, rather the balances of the machinery was given to you with rupees 10 lakh. And he says that the provision of depreciation account balance on the same date. Now provision for depreciation balance carries which balance? Credit. Right? So it balance brought down would be on the credit side. What this balance shows, actually these two balances shows that as on 1st of April 2024, if the machinery was of rupees 10 lakh and the provision was of 2,50,000, what was the actual value of machinery after depreciation, that is rupees 7,50,000. This is what these balances mean. Now in the question it is given to me that a part of machinery was sold for rupees 3 lakh, right? 3 lakh was sold on 31st of July 2024, let's say for rupees 2,50,000 it was sold, right? So here a part of machinery of rupees 3 lakh. So first of all you must know that in your machine account you were having 10 lakh of the machinery previous to the depreciation, and here you have sold the machinery of 3 lakh. Then how much should be the balance of your machinery account, that is 7 lakh. Under this method it is very easy to judge that as on 31st March 2025 by balance carried down of the machinery should be rupees 7 lakh, because out of this 10 lakh machine of rupees 3 lakh was sold. So we are clear in this case that this account should make a total with rupees 10 lakh on the both sides, and representing to be to balance brought down should be with rupees 7 lakh, as there was no purchase of machine given to us, right? Now the point is this, that how to take the value that is as on the date of the sale. Here it's given to me that part of machinery which cost rupees 3 lakh out of 10 lakh valuation, right? So I have told you the method of your cross multiplication, because I need to take the depreciation firstly on the date of the sale. It was sold on which date? It was sold on 31st of July 2024. Remember in the long questions where provision for depreciation account was not prepared, date of account, opening of financial year and date of your sale are different. Then we put over here first point, that is by depreciation from the date of your financial year to the date of sale. So here from 1st of April 2024 to 31st of July 2024, we use the asset April, May, June and July, because the date is 31st July. So we use the asset for 4 months. So what was the depreciation on the asset for 4 months? That depreciation is not to be taken here. In which account depreciation is charged now? In your provision for depreciation account. So here as on 31st of July 2024, we have to take the depreciation. What was the value of machinery? 3 lakh. The rate of depreciation 10%, fixed installment method. If it would have been the full year, then depreciation would have been 30,000. But for 4 months, the depreciation would be 30,000 into 4 divided by 12, that is rupees 10,000 here. So how much depreciation was charged for the given year? That is rupees 10,000 in this case, right? Is it okay with everyone? So here we have charged the depreciation with rupees 10,000 on the date of the sale. Now on the date of the sale, I have told you that we will take the amount from here of the machinery which we sold, the part of depreciation was charged on that. That depreciation would be taken to here. The full depreciation would be taken to which account? That is to your machinery account. Now, there was a depreciation of rupees 2,50,000 on how much value of machinery? 10 lakh. Now on 3 lakh value of machinery, how much would be the amount of depreciation? How we will calculate here? That is by cross multiply. So 3 lakh multiplied by 2,50,000 divided by is your 10 lakh will give you the value of your depreciation on this machinery which we have to transform from here. That becomes up to rupees 3 lakh multiplied by 25 upon 10 lakh. It gives you 25. So I took the zeros here. So it is 75,000 rupees, right? So how we took it exactly? 3 lakh, that goes with the 10 over here. 3 lakh, lakhs cancelled with the lakhs, 10 was left, 0 cancelled over here. So 3 multiplied by 25, 75 and 3 zeros there. So how much is the depreciation? That is 75,000. Now out of 2,50,000, 75,000 depreciation belongs to the asset sold and 10,000 was also charged for the asset which was sold. So how much is the total depreciation that we have to transfer here? That is 85,000 rupees. Now in this case, the machinery which was sold was actually of 3 lakh minus 85,000 rupees of total depreciation which we took on that machinery. So what was the remaining value of asset? That was 2,15,000. It was sold for what value? 2,50,000 by a bank account. The machine was sold for rupees 2,50,000 here. So the sale value of the machinery is more than the remaining value. So that gives you a profit on sale with rupees 35,000. So there is a profit with rupees 35,000 on the sale of the machinery which would go with the value 35,000 because profit, so it should be debited, right? Now you have to make the total of the account and check whether it left out with the 7 lakh or not. 10,35,000 minus when we will be making for 2,50,000 plus 85 gives you 335. So 10,35,000 minus 335 gives you a balance of 7 lakh. So my machinery account is correct here. Now leftover is provision for depreciation account. As the year is ending on which date? 31st March 2025. Although from 10 lakh rupees of the machinery we have sold the asset of 3 lakh. What is the value of machinery left? That is 7 lakh. That 7 lakh rupees machinery was used for the full year because that was not sold. So 7 lakh rupees, 10% is the depreciation rate. How much should be the depreciation on that very asset? That is rupees 70,000. So what is the total value which we took over for here? 3,30,000 less 85,000. That gives me 2,45,000 balance of your provision for depreciation account as on 31st March 2025. The point to be remindable over here is when you have sold a part of your asset, on which date it was sold, that is not calculable for the part which is left with you. That 7 lakh rupees you have used from the 1st of April till 31st of March of the next year. So full year depreciation would be charged on the balance of your asset. So So now this balance would be brought down as on 1st of April 2025 by a balance brought down. What is the balance brought down for your this provision for depreciation account is to like 45,000. What is the balance brought down for here is 7 lakh rupees. So what is the value of machinery we asked me for after depreciation? 7 lakh minus 2 lakh 45,000 would be there. So this is how the case of your when your balance given date is different from the date of the sale, how you will calculate. You will do the method of cross multiplication plus you will add the depreciation. Here we charge the depreciation 75,000 for last year and for current year as we use for the 4 months. What was the amount of depreciation? 10,000 rupees. So we took a total value of 85,000 rupees as a depreciation on the asset value sold. So that is for the day. I hope you are clear with the question. If any query, kindly put it in the comment box. Thanks for the day. Accountitude, like, share and subscribe. Keep scoring.